What if the biggest investing mistake you're making is not losing money in the market, but never really seeing how money works in the first place? Not because you're careless, not because you're lazy, but because no one ever showed you the dashboard. You earn $4,200 a month after tax in the US, or 3,100 euros in parts of Europe. Sounds decent, respectable, middle class? Then reality begins to subtract. $1,600 rent, $420 car payment, $280 insurance, $350 groceries, $120 subscriptions you barely notice, $500 student loan, $300 credit card minimum. You're left with maybe $600. And from this $600, you're supposed to invest for your future. So you do what most people do. You open an app. You buy a stock someone mentioned. You buy crypto during hype. You panic when it falls. You sell. You repeat. And you quietly conclude, investing is risky. No, blind investing is risky. Here's the real mistake. People invest without context. They buy assets without understanding the story those assets are living inside. They never look at market history, company financials, price trends over years, earnings reports, analyst expectations, economic environment. They treat investing like shopping, not like research. And this is where Yahoo Finance becomes unexpectedly powerful. Because Yahoo Finance is not an investing app. It's a financial dashboard most people never learn to read. Let's take a simple example. You buy a stock at $120 because it's trending on social media. You invest $2,000. 2 months later, it drops to $90. You panic. You sell. You lose $500. This happens 3 times in a year. You don't notice it clearly, but you've lost $1,500. That's not market risk. That's information blindness. Now imagine something different. Before buying, you open Yahoo Finance. You look at the 5-year chart. You notice something. This stock has a pattern. Every year after earnings, it drops 20 to 25%, then slowly recovers over months. This drop you panicked about was predictable, visible, historical. You wouldn't have sold. You might not even have bought at $120. You might have waited for $95. That one habit changes everything. Humans are emotional in short time frames. We react to red numbers. We react to headlines. We react to noise because we never zoom out. The brain fears immediate loss more than long-term damage. So we make decisions based on today's movement instead of years of behavior. Yahoo Finance quietly forces you to zoom out. It shows you 1 day, 5 days, 1 month. But more importantly, that view changes how your brain thinks. You stop reacting. You start observing. Now extend this behavior over 10 years. Every year you lose $1,500 to bad entries and panic exits. That's $15,000 gone. If that money had stayed invested at an average 8% return, it would be over $23,000. You didn't just lose $15,000, you lost what that money could have become. This is how middle-class investors stay middle class. Not because they don't invest, but because they invest emotionally. Another quiet mistake. People buy companies they cannot explain in one sentence. They buy because of hype, but never check revenue, profit, debt, cash flow. All of this is visible on Yahoo Finance in one page. Simple tables, clear numbers. You don't need a finance degree. You just need to ask, is this company actually making money? Many aren't, and you only realize this after the stock collapses. Imagine buying a European tech stock at 60 euros. You put in 3,000 euros. You never check earnings history. If you had, you'd see the company hasn't made a profit in 7 years. Revenue is flat. Debt is rising. The stock wasn't an investment. It was hope. Yahoo Finance shows this in 30 seconds, but most people never look. Financially intelligent people don't ask, "Is this stock going up?" They ask, "What story has this stock been living for the past 10 years?" They don't chase movement. They study behavior. They don't buy excitement. They buy understanding. They spend more time on Yahoo Finance pages than on trading apps. Because the real work is not buying. The real work is knowing. People think stocks move randomly. They don't. They move with interest rates, inflation, economic cycles, sector trends. Yahoo Finance shows market news, indices, sector performance. You begin to notice patterns. Tech stocks fall when rates rise. Energy stocks rise during oil shocks. Banks react to policy changes. Suddenly, the market feels less like chaos and more like a system. You stop asking, "What should I buy today?" and start asking, "What is happening in the world right now?" This one shift separates reactive investors from calm ones. Most people don't lose money because the market is cruel. They lose money because they enter a complex system without a map. Yahoo Finance is not exciting. It's not flashy. It doesn't promise profits. It quietly gives you the map, charts, history, data, context, but only if you choose to look. Investing is not about speed. It's about clarity.
Not about tips, about understanding. And sometimes the difference between losing $10,000 and growing $10,000 is simply spending 10 minutes looking at information you used to ignore. If this changed the way you think about investing, consider subscribing for more calm, honest explanations of how money really works.